Disadvantages of trading CFDs. Leverage can be a double-edged sword. That is, margin trading means your potential profits are magnified, but it is also important to remember that losses are also magnified. So it is essential to apply appropriate money management techniques. Trading CFDs is higher risk than trading shares. Even though you don't need to deposit the whole value, you could still lose your initial margin. Plus, if the market moves against you, you may also need to meet a margin call where you either contribute more cash or be forced to sell down assets. For a short position, investors are exposed to potentially unlimited loss. Positions that are held overnight are subject to overnight financing. Financing consists of a daily charge based on the size of the contract and is linked to LIBOR. Long trades held for extended periods of time attract ever-increasing interest payments. The interest charge for long positions held over large time frames can significantly reduce the effectiveness of return in many cases, rendering the leverage obtained as comparable to buying a contract or share completely in the market. Interest payable on the whole transaction. As opposed to margin lending, the contracts for difference trader has to pay interest on the total transaction market exposure, irrespective of the margin that they have contributed. Inflexible leverage levels. The CFD provider sets the margin level applicable to each market. The trader has to accept this level and try to come up with the risk management strategies around the level. The leverage level can be changed as the CFD provider sees necessary. Therefore, if the CFD broker increases the margin required mid-trade, the trader may have to contribute more margin monies to avoid being closed out. No shareholder rights. A CFD investor has no rights as a shareholder since there is no physical ownership of the underlying asset. Ease of access and low capital requirement can lead to overtrading. For more information, visit www.contracts-for-difference.com.